Everybody, this is your host, Robert Kientz with the Freedom Report, formerly Gold Silver Pros. For those of you that looked for my Gold Silver Pros channel, couldn't find it, we just renamed it, and we talk about all things gold and silver and other stuff. We're doing our weekly market wrap-up for the 13th of August, 2024. So we're going to focus on gold, silver, and what's going on in the economy, as we always do. There's not as much in the economic data that I want to go over, as much as there is in the results of the economic data and the stories that we're seeing about the implosion of retail. We're going to get into gold and silver, and I promised you guys this week I would do a deeper technical dive on gold and silver, and I'm going to use the charts. The last time I did this a ways back with the Fibonacci technical levels on it. I'm going to run you through that, and then we're going to take a look at some of the mining stock indexes, the GDX and GDXJ, which have broken out this year too, and no one's talking about it. This is the quietest gold bull market I've ever seen. And that's really what we're going to talk about today, but let's dive into it. So we're going to do a little bit of economic data. There's not a lot there. I'm going to put my glasses on so I can read all this stuff. The monthly budget is a little bit higher this month. The optimism index of consumers is a tad higher. Producer price index fell a little bit. Core CPI is up just a little bit. Producer price index is about even, or a little bit less. So it looks as though in some areas prices have fallen just a bit, and there's a little bit more confidence because of that. But these are lagging numbers, and these government data don't reflect what's what the retailers and the service industry is saying. So what we're going to do here is we're going to draw a disconnect, or I'm going to tell you the difference between what the government is telling you and what we're seeing in real life. And this has been the theme of a lot of my videos over the last month, is discussing what the government tells you in the data and then what we actually see. And if you go to my book, Drop Shadow, The Truth About the Economy, which you can get on Amazon if you wish. Older book I wrote in 2009, but I spent chapter 2 telling you this exact thing, that the data and the experience of people doesn't match, and so the government numbers were messed up. I even did a recent video where I went over part of chapter 2 in the book, talking specifically about CPI and all the ways that it had been screwed up by the government statistics. Using their own data, hard data, and studies done from reporters and analysts. And, that's true of all the government numbers. And so that's going to be a recurring theme where we talk about the government numbers aren't right. The government numbers aren't right. Even though they're not right, they're still showing a recession, but they're really not right in that they're just completely off. And that's the theme. And that's what we want to talk about. It's much worse than the government is saying. And we're going to continue to do videos where I break down different government numbers going forward. But let's dive into it. Later this week, of course, we always get initial jobless claims for the week. We'll get manufacturing from Empire State, which is northeast New York and surrounding area, Philadelphia, Fed manufacturing survey. We'll get industrial production capacity utilization. This week, sort of the second to third week of the month, is where you start getting a lot of these numbers that people don't pay attention to, but are really important in terms of production and growth in the U.S. We'll have a ton of those as the week goes on. Looking last week, not a ton going on. Our PMI numbers in terms of how the Purchasing Managers Index felt like for the services part of the economy was going to go was a little bit less optimistic than last month, but just off by a hair. It's a 55 where it was a 56 last month. The actual services index, ISM services index, actually measuring another measure of how services is doing, was slightly up from 48.8% to 51.4%. So the economy is sort of bobbing along, but it's having a lot of problems underneath it. And we're going to get much more data next week to go over. And if you watch last week's video, a lot of data. This is sort of light on the data. But overall, we're starting to see serious signs of problems. I'll get into those stories in a minute. Let's talk about the markets. Right now, the Dow is down 22 bucks, although it did close up on the day. Stock futures are a little change ahead of key inflation report on Wednesday, according to CNBC. S&P futures, NASDAQ up slightly, flat line about the same thing. Cryptocurrencies have done very well. When I looked at them earlier, yeah, Bitcoin right now is at 60,692. Up 1604 on the day, and since last we did the report, it's up about $6,500. The rest of the crypto complex is doing pretty well. Ethereum Class is at 1919. If we look at Litecoin, it's at 63.25. That's up $2.18. Ethereum Classic's up 32 cents. XRP is up a penny to 58 cents. Last week was 51. Stellar Lumens is just a penny unchanged. Zcash is up a little bit to 42.2. Cardano is up to 0.34. Polygon 0.42. Cheap network. So the crypto complex is up a little bit, and I think it's a delayed response to what's been going on in the economy. You saw gold pop first, and we'll get to our deep dive in gold later and in silver, but you're seeing the cryptos respond a little bit here with some optimism. Based on a falling dollar, the DXY over the last few weeks has fallen just a bit from like a 104 to like a 102.5. So there's a little bit of weakness in the dollar relative to other currencies. The DXY is a dollar index. It's a basket of I think it's like 6 total currencies. If I remember, I have to go and look at it again. The dollar against those currencies, other major ones like the pound and that type of thing. And it's fallen a bit. So they're a little bit better, better performance of the other large world currencies to the dollar, but that's not a measure of inflation or the overall weakness of the dollar. So I don't pay too much attention to it, but whenever the DXY goes down a little bit, gold goes up a little bit, and things like Bitcoin will go up too, because it's an indication that dollar's under a little bit of pressure. Looking at the yield curve inversion and the 2 and 10-year Treasury rates, those are the U.S. bonds or treasuries, the debt that they issue to have to pay back. We look at the rates to see how much they're going to have to pay back with interest, because that raises borrowing costs and creates a huge pressure on the government's budget, because we're now paying a significant portion of all our tax receipts and all the money the government receives through tariffs and things like that is going just to pay, you know, interest on the debt. And at some point, when interest rates rise too high, they can't afford to pay interest on the debt without cutting a bunch of stuff or going even deeper in hock. And we look at the difference between the 2 and 10 years, see if we're a recession risk. Now, for about the past year or so, the 2-year has required a higher rate, meaning people thought there was more risk in the short term, meaning chance of recession. And I said this every single week, and I know you guys are watching every single week, are probably tired of hearing, but the new ones aren't. Whenever the 2-year is trading at a higher rate than the 10-year, it means recession. It's been 100% correct when that's happened, for a significant period of time leading up to a recession. So usually it means between 6 and 18 months, it'll lead to a recession. It's been going for over a year, so that means we're within 6 months of a recession, if that indicator historically holds the way it has in the past. Now, that doesn't mean it's going to be the big, huge crash, but just a significant recession, especially with the amount that it was inverted between the 2 and 10-year. Right now, the 10 years at 3.847, the 2 years at 3.936, which is higher than 3.847 by almost 0.1 of a point. Now, that spread has closed the gap lately, and the overall interest rates on bonds have fallen down. The bond market was feeling pretty good there for a while about the economy, but there are signs the economy slowing down, and the bond rates have slowly creeped up in the last week or so. They're not near the 5%, about a percentage off of the 5% that we saw, pretty close to at times the last couple of years. And so I think that's a misnomer, though, because as the stories I'm about to show you point out, the economy is in much worse shape than the investments are reflecting. And later on, we'll get into a chart on the stock market as well and tell you where the risk is there. So get into the stories. Then we'll get into gold and silver, the deep dive. Then I'll talk about the mining stocks, just like I promised. On the story front, according to supplychaindive.com, the USPS, which is the Postal Service, sees a steep drop in expedited shipping demand. This is its Priority and Priority Express package delivery. The agency's priority mail services volume dropped by 40.7% for the quarter that ended June 30th as shippers moved to more cost-effective options. Just a couple of bullet points here in the article, and I'll move on. The U.S. Postal Service expedited package shipping services have seen a steep drop in demand, according to quarterly results released Thursday. The agency weathered a 40.7% decline in priority mail services volume year over year for the third quarter fiscal year 2024, meaning 2024 third quarter compared to 2023 third quarter year over year, which ended June 30th. The category includes shipments for Priority Mail, which offers delivery in 1 to 3 business days, and Priority Mail Express, providing delivery in 1 to 2 days, or overnight, if you will, or within 24 hours. Our Priority Mail Services subcategory can be more price sensitive than other services and continues to face intense competition for more affordable products, and an industry-wide trend away from expedited products, the Postal Service said in a quarterly report. Essentially, all of the shippers are seeing companies like Amazon, which has removed a lot of its next day and 2-day delivery services, even for Prime members, and other large retailers, even small retailers, move to less expensive shipping options because the inflation on shipping's got so great it was preventing people from ordering stuff. So instead of saying, I'll give you 2-day shipping to your address across the US with priority, maybe they're moving more to a ground or to a cheaper service, which may be 4 to 5 day, and just saving that on the bottom line to save consumers money. That's an indication consumers have less, and also that inflation is killing trucking. Now, I don't have a chart for you here on this, but trucking has absolutely started to crash. It's been crashing for a while. Next week, I'll try to have a chart for you on that. I just wasn't prepared. But trust me when I say the trucking indexes have been falling for quite a while. They've been falling on and off for about 1.5 years, but they really have taken a steep decline as of lately. So less truck rolls, and the economy is not good because it means people are buying less. Because even though we don't manufacture everything, even when stuff comes from overseas, we got to put it on truck to get it the last mile. You can ship it up shipping lanes, you can fly it, but the trucks are what gets it out to the people, not only to warehouses, but from warehouses to the public. And the trucking industry is suffering right now because that has fallen. That's decreased demand on oil and gas, which has kept their prices moderate, even though during the summer they usually go up a lot because trucking fell. And that's a big user of petroleum. And now we also see it in the package shipping services like USPS. I'm also seeing indication of this because I have a shipping account with a major shipping provider where I can ship any major carrier, including DHL, FedEx, UPS. And we're seeing little ribbons come across my portal there that shipping rates are definitely down. And so I don't know what that's going to do. I'm sorry, shipping volume. I don't know what that's going to do long-term for shipping rates, if it's going to push them up or if these shipping companies will be able to cut costs. But I suspect that inflation and shipping costs has affected the consumer. They're having to back off. They'll probably do some layoffs. Trucking's not as good. And that's just a sign we're hitting the real recession. Regardless of what the numbers say, when packages and shipping start to fall off, that means the consumer's not healthy. Another by constructiondive.com, a couple of different dive websites here. Market headwinds force owners to hit the brakes on electric vehicle projects, EV projects. This is published August 13, 2024, Construction Dive by Sebastian Abando. It says here, financing woes, soaring material prices, and waning demand are causing auto and battery makers to delay jobs, even those that have already started. Once a bustling site poised to power electric vehicle revolution, a $2.6 billion battery factory under construction in Lansing, Michigan now sits at a near standstill. Its future frozen as economic headwinds stall its progress, according to the article. EV battery maker Ultium Cells, a joint venture between General Motors and LG Energy Solution, placed construction of its facility on hold in July amid sluggish market conditions, namely high interest rates and concerns about electric vehicle demand, according to the company. It intends to resume construction once it is clear understanding of this outlook, an official from LG Energy Solution told the Korea Herald. Uncertainty about interest rates is causing many on-hold projects to pile up like water behind the dam, according to Richard Branch, chief economist for Dodge Construction Network. These high rates are especially problematic for projects done in phases like multi-billion-dollar EV plants, where owners need to seek funding to complete each new phase of construction. It's a very CapEx or capital expenditure intensive sort of operation to do these plants, and they're stopping. Once the plants stop, that's an indication that demand has stopped and that costs have risen, and that's an indication of where we are in the economy. Pay attention to all these news stories. According to Zero Hedge, this one from Zero Hedge, Home Depot slashes sales and profit outlook as higher rates pressure demand. According to Jeff Mack on X or Twitter, this is aging pretty well so far. Home Depot beats, guides everything lower, says, meaning they beat expectations for the quarter, but they say, oh, it's trending down. Guiding everything lower, meaning in future quarters, it's coming down. That's what that language means. According to the tweet, it says foot traffic weakened as the quarter progressed, guides to decline of 3 to 4%. Same store sales, SSS. HG expects business to get work in the back half of the year, which is bad, and it wasn't part of their previous guidance. So the biggest, one of the two biggest, I think, with Lowe's maybe there's other chains, but definitely the biggest in my area, home services, construction, repair is trending down. And they're saying same store sales have gone down, traffic's gone down, less people, less contractors, less homeowners, less do-it-yourselfers, which means that consumers have less spending to fix things and build things. And people that are constructing homes, I've told you about the real estate market has fallen off. Smaller homes, less demand. is going to affect people like Home Depot as well, because some of the stuff you're going to get from Home Depot, you're going to order some in bulk, some you're going to get at Home Depot. So the whole residential construction is down, commercial construction has been way down, and rehab projects, that type of thing that you may pay for by getting a home equity line of credit or refinancing your home. We know that refinances are starting to fall. And so the money flowing into Home Depot is starting to fall. Again, consumers dealing with inflation, lack of credit availability, maybe they've already used it, lack of jobs, that type of thing we're seeing at Home Depot. Something that I already knew because my daughter worked in the industry. For those that don't know, my daughter was an actress for many years and is still doing it, but taking a bit of a break to go back to college just in the short term. She'll still work projects. But she had been telling me that over the last few years, since the shutdowns in 2020 and the worker strike that they had basically last year and part of this year, that the money wasn't there. And the worker strike really in the entertainment industry was a result of not getting the raises and things they thought, but the overall pie had shrunk in the entertainment industry. And now it says here, according to an article first obtained by the New York Times, Paramount, the big studio, cuts 15% of its workforce, U.S. workforce, closes a TV studio as traditional TV market slumps. Paramount, the parent company of CBS News, BET, MTV, Nickelodeon, dozens of local TV stations, and Paramount Pictures announced an internal memo from top executives to employees that the first round of job cuts is set to begin. The multinational media conglomerate Manhattan plans to reduce its U.S.-based workforce by 15% or 2,000 workers by the end of September. That's about a month from now. Troubling news for the company that struggles migrating its one-time TV viewers to its streaming video platform. A quote, the industry continues to evolve and Paramount is an inflection point where changes must be made to strengthen our business. And while these actions are often difficult, we're confident in our direction forward. Brian Robbins, the head of Paramount Pictures, George Cheeks, the head of CBS, and Chris McCarthy, the head of Showtime and MTV, wrote an internal memo to employees, again published at the New York Times. So all areas of the economy coming down. You would think that people couldn't afford to go to movie theaters, they would stream. Well, now even the streaming services are seeing challenges. This is as people move stuff off of their budget to make ends meet and deal with inflation and deal with the fact their salaries aren't going up and they can't pay all the bills at the end of the month and their credit cards are maxed. You're starting to see it even on the cheaper services. Like how many people are paying $100, $150 for cable, dish, or even streaming services anymore. Maybe people are doing cheaper a la cartes and only watching a couple of shows, or maybe, I mean, you're starting to see it at all ends of the spectrum. All right, we're going to get into the rest of the program where we show you stuff on screen. This is an interesting one from Visual Capitalist. I wanted to point out that stock ownership of U.S. household and nonprofits is at an all-time high, 41.6%. Why? Because stocks is the only thing right now, other than gold, and maybe the cryptos, even the cryptos is not consistently returning. The only thing outside of gold consistently returning are the stock market, and that's because that's where the money goes first before it goes elsewhere. And so that gets pumped, and that will be the last thing to sort of crash. We did see some pullbacks recently, which I think were a warning sign, canary in the coal mine of what's to come as more of these earning reports come out and we start to have more economic issues. You started to see that stock market slump. Of course, we had Stephen Hochberg on the program 4 or 5 months ago saying this would happen about this time, that we start to see stock market weakness. I re-put a clip, a 2-minute clip of his interview that we did 5 or 6 months ago on X, on Twitter, and pointing out that we kind of predicted this. He uses Elliott wave and technical analysis, but there were patterns in trading, and it's pretty obvious the stock market is not in the best of shape, but it's owned by more people because it's the only thing returning outside of gold specifically, but gold and silver, returning a significant amount for general investors to invest in, and they're holding on to it. Now, a lot of those funds are captured in pension plans and 401ks, so they can't get it out. And so people will have this false sense of hope on what their stocks are worth, but look at some of these crashes and look at the amount of people, 1982, after high inflation, not many people owned it. So people will sell off stocks essentially when they go through economic problems. You saw that happen after the big inflation. We're about to have another big inflation. This chart will come back down. People sell stocks and buy other stuff. We expect to go into gold, silver, maybe some of the cryptos. In case, it's all from data from the Federal Reserve, but it's at an all-time high. Today, the proportion of Americans' financial assets invested in public stocks is nearing record highs, just shy of the peak seen in 2021. Overall, that's not good because those people are going to get slammed the hardest, but that's what people are putting money into because they're trying to keep up with inflation. So the gambling in stock market is the most institutionalized and most popular gambling market, even more than going to your casino. So it makes sense as people get more desperate to make ends meet, they're going to gamble with their money more. And whenever the big rollover in the stock market comes, it's really going to hurt a lot of people. This next recession, just because more people are invested in the stock market, are going to lose more wealth than probably any other stock crash in history, as a percentage of the fall, because there are more people into it. And then we'll see if the overall fall, we know there are more people into it, so a higher percentage of wealth lost in this next recession based on the number of people. But is the overall number bigger based on how much the stock market's going to collapse? We'll have to see. I think it's going to be a big collapse. So I think the fact that you have the most people in it as a percentage of households, and it's going to be one of the bigger collapses we've seen in a long time, is going to be one of the biggest destroyers of wealth in U.S. history, even more than the stock crash that led to the Great Depression, or was a part of, essentially, the Great Depression. All right, looking at the charts, December is the big month. December will be the big month going forward for both gold and silver. You're going to see all the contracts loaded there. We're about to be in the last quarter. That's where everybody's taking their long-term positions ending the year. There'll be big physical delivery months because of the amount of contracts and because people try to take delivery. And I expect, particularly this year, because of the economic issues, that people are going to look for gold even more so than silver right now, because they're trying to capitalize their balance sheets or remove risk or get into something safe. And a lot of the well-to-do, smart people, those types of things, are kind of ahead of the game on the markets, more so than the middle and the poorer people are going to get into gold faster. So I think the physical demand is going to go up, and we've definitely seen that. Heavy volume as of, let's see what this data was as of today, as of this morning. So we'll say yesterday's data, 171,000 total volume. Clearport, which is private over-the-counter transactions, OTC transactions that can be put into the market after they've been agreed to. EFPs, which is moving from a futures position in the US to the over-the-counter market over in the UK. So 2 over-the-counter indicators. And trade after settlement, which is trading after the close day of a price. When you make a trade and you put it on the market the next morning, or whatever the next available trade window is at the previously closed price, remove some price risk, is up. Block trades, 841. All of these things signify that people are trying to grab a price and trade and go for the physical, or they're going to move to the OTC market over in the UK to see if they can get the physical. It's an indication as gold price goes up, there's more demand for the physical, which is good. Settlements, if we look at it, I just look at this to show you this is where the spot price is determined. It's not in the physical market. You can just track it. So as of Monday, about middle of the day, we're up $30 on gold on all these contracts, and that's what determines the price. You just go and look at the settlements and you follow it. It's basically spot price. It's a derivative or paper traded market. Here's silver. We look at volume and open interest. Overall volume is regular. So silver hasn't been moving quite as much as gold, which is normal when gold's making a run. Gold will move if it sustains it. Silver will fall, and I'll show you in the technical chart what that's going to look like when we get here in a moment. A lot of volume on silver, 82,986. September still kind of the bigger contract, but honestly, people are rolling to December. You see 5,000 contracts removed yesterday, and most of those, well, almost every single one of them was put into December. So December, by a few more days is going to be the big month. So it's December or bust for gold and silver in terms of price setting between now and the end of the year. That's where all the price action is going to be in the paper trade. And it will set up for how much delivery are we going to have in December, because there's so many contracts in December in gold and silver. There's going to be delivery. And I'm interested to see this December's number. If it's a big blowout number, like I think, that may be the last chance for some of these parties to get big gold and silver before we have economic contagion and it gets pulled from everywhere. So I think people are front running the coming tsunami in gold and silver demand by taking it off these exchanges, in other words. But pretty soon the exchanges are going to run out of liquidity and people are going to go everywhere. And when you see this kind of activity on the market, you see the Clearports and the EFPs and the trade after settlements and the block trades. And, you've seen higher physical deliveries this year in each of the deliverable months, about 6 each for gold and silver. Then you get the picture that people want the physical in the worst possible way. And that's what we see in the data. Looking at the settlements data, About noon today, silver was up about 42 cents on all the contracts. You can go all the days if you want. I'm not going to do it, but this is where spot price determined. This change column right here tells you the change in the day, and the average settlement price is basically your spot price. And it tells you the volume, so you know which months are the biggest. Right now, it's September. It's quickly moving to December. Looking at the commitment of traders, we know the price has risen a little bit. Why? Because the swap dealers didn't add a lot to their short position, relatively speaking. If we go down here and look at silver, gold and silver, the most shorted metals on the market, more than platinum, palladium, any other metal or any other product, by the way. Largest concentrated short position is in gold and silver. We know that by looking at the Office of Comptroller of the Currency report. We also know that by looking at these 4 or less traders and 8 or less traders statistics. Short 8 traders own 53.8% of the shorts. Conversely, the biggest 8 traders only own half of that amount of longs, 24%. So the longs are more distributed, the shorts are more focused, and it's mostly the big banks. We know that from the OCC report that I mentioned a minute ago. Same thing in gold. Gold, 8 or less traders, short 42.1%, 4 traders 31.6%, but on the long side, it's much less. So I'm sorry, that's platinum. I'm going to go down here to gold. Excuse me, 58.5 in gold, short, concentrated, only 27.6, long concentrated, top 4, 40.4, and then long 17.6. So you can tell that the big banks are in there shorting the hell of gold and silver. They make money on the derivative trade by paper contracts. We go over how all those games are played. I won't do it today, but now they have to cover their shorts because they had a huge short position. If you look at swap dealers, the bullion banks, they're 60,835 contracts short on silver. This is silver here. This is the swap dealers or the bullion banks. This is their long and short position. You see long and short columns here. So they're more than 2 to 1 short over long, whereas a few months ago they were dead even. And if you look at the managed money, the financial houses, they're 3 times long. If you look at the wealthy individuals and the family offices, that type, they're 9 times long to short. So it's the swap dealers, and you'll see there's a big short position in producer merchants, but that's a legitimate heading for the actual physical product that they either use or sell. So I don't worry about this column. That's usually pretty steady. The amount of shorts don't go up a lot every month. The short play, the change in short position almost every month goes through the swap dealers. That's how you know it's speculative interest. If the swap dealers were really covering all the mines, which you don't have to because the miners have their own category, but if the swap dealers were really only covering mining output and legitimate hedging, they wouldn't swap their positions so much because it would just lose their clients all the money. They're swapping positions to hit price targets so that they can make money on the trade, both in the futures market and the options. That's how you know that they're the big speculative short. But they did release, they only added 703 short positions in silver and subtracted 13 long. So they did net a little bit more short last time, but not a big move. But that was enough to keep silver from breaking out. Well, looking in gold, it broke out because they dropped, this is gold. Here's the swap dealers long and short, okay, right here. They dropped 4,301 short contracts and added 1,902. That's a net position change of 6,100 to the long side, to the bullish side, to the price upside. Well, what's happened to gold and silver price the last week? It's gone up, especially the last few days. Whereas the managed money is dropping contracts all over, exiting some of their summer positions, gearing up for other markets in the fall that are more popular. So this is normal for the managed money financial houses. They're just going to reduce their overall interest a little, move their money to maybe some other areas, but they reduce more longs and shorts, so they're a little bit net short. The other reportables remove more longs and short, a little bit net short. So I think the smart individual traders and the big financial houses expect gold to come down a little bit in the fall. I think that's the opposite. And I expect the swap dealers, the bullion banks, expected to go up based on their positioning. And because the bullion banks are the smartest ones in the market, because they're the market makers, they write the reports that the financial houses read to take their position in gold and silver, and they can move the markets with the biggest concentrated positions. You always follow what the swap dealers are doing because that's an indication of what's coming next. They're going long in gold and about the same in silver. Well, look at the charts. What's happened to gold? It's gone up a little bit more than silver. So it's matching the positioning in that paper market with what's actually going on the next week. This is last week's paper market data with what's actually going on in the last 7 days in the market. They all match up. That's why I do it, just to show you it matches. That's all. This is how the market works. This is just to explain. It's an explainer video every week to show you how it works and then walk you through the changes week to week. And if I do this enough times and you guys are all getting your friends to the program, then maybe we can actually educate the heck out of people using data, not a bunch of conspiracy theory and fear-based stuff and XYZ group 5,000 years ago did this and this guy, you know, I let other people get into that kind of stuff. You just look at the data and you can tell, and the news flow, and you can tell what's going on. You don't need to worry about all the other stuff. It's just right here. It's obvious. And if you learn the market, you can actually do this yourself. I encourage you to do it. All right. I'm on TradingView and I'm using a chart I showed, a month or two ago where I drew some Fibonacci sequence. I took the Fibonacci of gold when it was at a set price before it had a free market again with the passage of the 1974 Commodities Act and the release of gold as a backup to the dollar. It became commodity instead of money in the eyes of the U.S. government. And so it started, moving around in price. So I took the bottom and then I took the top of 1900 and then the top here in 2020 during the shutdowns. And I said, what would be the next breakout point? Because this is your big rise. And then it kind of, you had this big cup and handle. Those who've been following me for a long time, I'm famous for talking about the cup and handle between the high in 2011 and the high in 2020. So between the last two big economic events to hit the country, the meltdown, the subsequent rise of the gold silver price from the Great Recession in 2009 to 2011, where gold peaked at 1900, and then the shutdowns, which caused gold and silver to peak again and reach new all-time highs around over 2000, almost 2100, I believe. And that's a cup and handle pattern or cup pattern. And then you have this handle. When you see that pattern, a little cup with a little handle coming off, that usually means it's going to break to the upside. And what's happened? It's broken to the upside. Okay. From November of 23 to now, we have broken from about the 1900 range to the 2500 range. And to date, this year, gold's been up almost $500, 470 something bucks, almost 25%, about 22, 23% year to date. Let's look at a year to date chart. You can see, we'll let it redraw. Is it going to redraw? Here, let's reload it and see if we can get this to redraw. Year-to-date chart. Here we go. So year-to-date, it started at about 2063. It's now at 2464. So it's $400 out of 2000. It's about 20% rise in gold just year-to-date. And you can see, looking at the Fibonacci's are these colors. When I looked at them, what was the breakout? When I first did this, we were sitting right in this range. We're sitting in this light blue. Since then, this has gone almost vertical. That is a fulfillment of the cup and handle I used to talk about for years. We finally have had the breakout of gold to the upside of that cup and handle, and this longer term Fibonacci pattern saying we've been in this really long-term bull market in gold since 1970. Why? Gold's measuring inflation. What happened in 71? Nixon took us off the gold standard. They started printing money as pure fiat, pure edict of the government, not backed by gold. You've had the steady inflation with some events mixed in here. And now here's the big breakout that's going to signal the end of the dollar era. This big breakout is telling us it's the end of the dollar era. We had this, 10-year cup and handle that's broken out. And this is a bigger breakout. This is sort of a cup and handle here where you sort of had this big cup leading down and then the breakout. So the couple of different positive bullish patterns there. And we're now at a point where we're at the top Fibonacci. So we're in the break free zone. So what that essentially means is gold is broken free of this 50-year pattern. Gold is broken free of this 50-year pattern, and I think it's going to continue to run. That doesn't mean it won't come down and do some of this for a while, but net, it's going to run. And I think it's going to run for years. And there may be buying points in there for you. It may come down to 2,200 at one point and go back up. But at the end of the day, the long-term trend is up. And it's clear when you look at it from a technical analysis perspective, gold's totally broken out. This is a trend line I drew from back, right after the financial crisis, the tech crisis in 2000 range, to where we started to have more, if you follow gold since 2000, it's beaten the stock market indices in terms of returns the last 25 years. And so that's what I graphed out. I graphed out gold's breakout since 2000, since the tech crisis, and then the great financial crisis and all the stuff we've seen in between. And this was the line. Well, now we've broken out. We retested the line, came out, and just have a straight breakout. that is about as bullish of a breakout as you can get. You've broken the 25-year trend line. You've broken the 50-year trend line. You're up into the top level of Fibonacci, which is a key trading level, which means breakout. We're in gold's breakout. Will it pull back here? Well, if the economic data gets better, it will. But what in the economic data is getting better? We go over this every week. It's getting worse. So there's no reason to expect gold to fall back down to one of these lower technical Fibonacci levels. There's no reason whatsoever. It's going to keep running. Silver, a little bit more muted. As we look at silver, I traded the breakout from about the same time frame. As the commodities market opened up in its modern day format with the hedging and the paper and all that stuff, you've seen huge swings in silver price. You see a really big cup and handle from about 80. Now, why did silver go up in 80? Because you had that big inflation. Okay, and that big inflation spiked gold and silver prices. And then Volcker raised interest rates, I think, to 18 to 19%, and it caused that inflation to come down. He just tightened the screws on the economy and reduced, monetary growth, and it caused everything to come down. Since silver sat here and range traded until we really got to the big crisis, the 2008, and then it popped up and again went to almost $50 in 2011. Well, this is a cup and this is a handle. It's more protracted than the gold market, but that's normal with silver. Gold will have an easier cup and handle. It's less violent, less speculative. Only 20-something% of gold is used in industrial use. The rest is as money, essentially. Silver is the other way around. It's the reverse. Only 20-something% is used as money or investment demand. The rest is commodities. So because it's in the commodity trade, it's more violent. There's more supply demand characteristics outside of just money. But you've seen this cup and handle pattern with silver, and it started to break out. Now it's much more muted. You're still sitting here with a couple of Fibonacci levels to go. You're not in a 50-year breakout in silver just yet, but gold usually leads silver. Gold is broken out. That's a 50-year and about a 15-year breakout in gold. Silver looks like if it can retrace back to about this level around $50 and keeps going to this top Fibonacci level, this bluish purple area on the chart, silver will have broken out. Now, what would be a confirming for silver would be if the mining indexes with silver in them, or the miners start to really break out. Now, when the miners start to break out, it's a confirming signal that silver is when you have gold. So gold's done it. Now the profit margins are going to go up a little bit in the gold miners. If silver starts to follow gold and those profit margins come up, it'll be confirmed in the mining indices because they're leveraged investments. They produce the silver, and every dollar over their cost is free money to them. It's pure profit. So as the profit margins go up on gold and silver, it raises the stock valuations of the miners. So we're going to look at the popular major mining index, the GDX. And you can see, this is a year-to-date chart, and you can see it rose from about a 30.58 to 37.38. So that's about $7 over 30, which is about 23%, not quite 25%. How many of you that were interested in the mining stocks even knew that they rose almost 25% as a class? You're looking at the majors and the mids. They've already risen that much. That's a confirmation that the gold breakout is real, and that more than likely we're going to have a silver breakout, because in here in the GDX, you still have some silver mixed in. A lot of these projects are a mix of gold and silver, and a lot of them are maybe higher silver projects. Certainly it's more gold in here. So the gold breakouts led to the GDX, the majors and the mediums, to break out. It's not a huge breakout. If we look at a 5-year chart of the GDX, it's about to refresh here. You're going to see that, it's not, I'm going to have to refresh the page to get it to work. It's not, as big a breakout as the yearly is. In fact, we're not to where we were 5 years ago. The high in 20 during, the shutdowns, the index got to 42.92, but we're getting close. We retraced most of the fall. It fell the most in 2022. After the fear subsided, after, the shutdowns, the gold and silver fell a little bit. The mining index fell down because it's leveraged, because as the price comes down, it works the other way. The stock prices will come down even more. It's a force multiplier because it's leverage, because you're dealing with a company, a stock versus a real metal. But then it's retraced most of that dating back to, what we saw after the shutdowns. So the gold and silver miners are getting frothy. They're starting to move. And on a year-to-date chart, having about a 23% gain on the majors and mids is not bad. Now let's look at the juniors. This is GDXJ. This is a junior gold miners. A little bit of silver in here, mostly gold. If you look at a year-to-date chart, it started at about 37.16. It's at 44. So you're 7 above over 37. So you're looking at about a 18 to 20% gain. The juniors move less quickly because they're not quite in production, and you're looking at just a pure balance sheet valuation to what they have on the ground but hasn't been pulled out yet. That's a little bit less stable than if they were selling the gold and actually making the profits. So the juniors will move up a little bit slower than the majors, who are getting the profits in, and therefore it raises the value of the stock. The juniors, it's just looking like their assets in the ground that they eventually want to monetize and build a mine for are getting more valuable. So they'll tend to pop, but that's more speculative. Like they're popping, but they're popping because 2 to 3 years from now, they're going to be mining, and we think it's worth more. A little bit difference between the juniors and the majors and the mids, especially the producers. So certainly some of the juniors are producers, but a lot of this is, more exploration or producing some, and you have a bunch of assets in the ground. So it's a little bit less, it's a little bit more speculative, moves up and down a little bit more than the majors. And if you go back 5 years on this chart, you're going to see that, so we can get this. Okay. I want to do a 5-year chart. Let's see if there we go. You're going to see the juniors really aren't where they were, in 2020. They've got a longer way to retrace. So if you're in junior mining stock investing, it takes longer for those bull markets to catch up and get you value. But the fact that we're seeing the mining index move is important. Now, one of my friends of mine, Don Durda, runs gold stock data, looks over maybe 500 perhaps stocks in his service, goldstockdata.com. If you're interested in doing the mining stocks, I fully recommend it. Here's his results after looking at his Q2 analysis. He's been updating the cost for all of his miner in Q2. The average break-even costs or free cash flow costs for gold and silver miners. It used to be about $12.50 for gold and about $22 for silver. Now he's saying for the gold miners, they need $1,850 to break even to get it out of the ground. The silver miners, $26. That's a huge rise. Why? Because costs are rising for the miners. So think about this. Inflation is killing the miners. So even though gold and silver prices are up, their profit margins aren't up as much as the pure price move because they're capturing all that inflation raging in the economy. So that's a $600 move in the break-even price for the major and mid gold producers to make money on their projects in the span of about a year and a half, 2 years. And with silver, it's about a 20 to 22% increase in costs. So certainly we have to, I will tell you that in gold especially, the gold price never sits below the cost to mine for any length of time. So the new floor for gold right now is $1,850. I think it's much higher than that. But if it crashed through $1,850, that immediately would cause some of the gold producers to stop producing, reduce the supply. Silver much less, because silver is a byproduct of many mines. The cost can go way up, or way down, and it doesn't affect as much the profit margins because of all of silver, because a lot of silver is produced as a result of gold and other mines. But so silver, in that case, is actually more susceptible to price moves because the major silver miners aren't that big and they need clear profit to mine. So because of that inflation, I expect some of the gold and silver miners to delay projects, which is going to reduce the overall amount of product they're producing, which is going to reduce supply in the next 2 to 3 years at a time when the world needs more. And it won't be until we've confirmed the silver breakout that the miners will believe the market is real and that the whole complex is going to go up and that they'll all start making money. So in other words, gold will go up first, then silver, and then the miners will go up. But then when silver pops and stays, the miners will really go up and stay up. I don't think we're quite there, but you're getting to the beginnings of not only the gold and silver bull market, but the gold and silver miner bull market is coming as well. And that's on the heels of all the data, that we talked about. And so there you go. There's your detailed report on gold, silver, the technical, the miners, and then some detail on what's actually going in the economy and some more on why the government numbers aren't trustworthy. Well, you can look at the government numbers all day, but what we see in real life is actually quite different. And what you really have to look at is the experience of all the people in the marketplace to look at what the real numbers are. Quick reminder, Kinesis is an affiliate of the channel. So if you sign up for a Kinesis account and go through your KYC, you get a free ½ ounce of silver for doing that and fund the account. It does help the program. Kinesis link down below. If you want to sign up through my partnership link, it does help the program. You don't have to do it, just throwing it out there. Kinesis allows you to buy gold and silver, not pay storage fees, but get paid for holding it and using it. You get holders and referrer yields and usage yields, as well as you can trade in and out of other things like into cash if you want, secure stored, all that good stuff, audited. And then if you're in the cryptos, you can switch back and forth between gold, silver, cash, and various cryptos on that exchange. So it gives optionality for people that are looking for alternatives to the dollar to basically bank there, essentially. And in many countries, they have a credit and debit card as well, which is coming soon to the US, we've been told. So this is a way for you to sort of put your money into assets that you think are secure, kind of use it as a bank, which if you put it at home, you can't use it as a bank unless you know somebody will buy it at, you know, the market rate. And that depends on local demand. But when you get on exchange, you have national demand, better pricing and buying and selling often at your local dealer. It's stored safely. It allows you to move it in and out to, you know, sell it for cash, move it to your bank account. You can redeem the gold and silver itself in certain increments. And you can trade in and out of the cryptos if you're into that as well. So basically, it's an exchange. And it allows you to do all those things. So if you're interested, Kinesis link down below. That's going to do it for this week. Later this week, I've got an interview with goldbacks. We're going to talk about what a goldback is and why it can be valuable to you if you're looking for a way to use gold in a transactional sense, a barter sense, in common units that are fungible and divisible. Stay tuned for that goldback interview on Thursday. I think you guys will enjoy it. We're going to talk about the history of it, how they make them, and we're going to talk about why it may be a part of your portfolio, especially if we have problems with the dollar, because you're going to need something to trade and barter with. And it's easier actually to do it with that than it is coins. And we'll explain that Thursday as to why. It gives you another option. All right, that's going to do it, guys, for the weekly market report. This is August 13, 2024. I'm your host, Rob Kientz, with the Freedom Report. And we have much more coming out. I've got other content that's going to hit the channel pretty soon. That's going to be very valuable to you guys. We're ramping up content. I thought I was going to go this summer and be a little bit light, but with all the stuff that's going on, we're going to ramp up the content. And we're going to get you everything you need, not just on the financial side, but other sides as well. So thanks for joining the program. This has been longer than I anticipated, which means the video will be late when it actually premieres tonight. But you guys pay attention to everything we got in here. It's good information, and I'll stop talking now. Till next time, see you. Rob with the Freedom Report.